in a row I've done this. So super stoked and happy. I have Jeremy from Dividend Stockpile. What's up, man?
Hey Russ, how you doing? Thanks
I
for having
am
me on. This
Yeah,
is exciting.
fantastic. So before we get breaking news, before we introduce Jeremy, I got to get to it. Tom Brady just unretired. Now, this is in his exact neck of the woods, down in Jeremy's neck of the woods. So big news. We didn't even talk about it. Are you a Bucks fan? Do you like football? Are you into it?
Yeah, we're definitely a Bucks fan, and here in Tampa Bay, you can't get away from the Bucks, but it's exciting. Obviously, you know, having Tom Brady here in the past has brought some excitement to the area, and to hear him coming back, it can only be good news. So super exciting for the city.
And I got to show it. So I'm going to share my screen here real quick, as I'm prone to do, because I was looking for a headline, and this just caught my attention. How crazy this is! So this is just a few minutes ago that Brady returns hours after the quote final touchdown pass. Football sells for more than 500K at an auction. So that just goes to show that nothing is certain in investing in buying footballs from Tom Brady's touchdowns. So anyway, that's
Absolutely.
interesting news to me. I love fantasy football. He's been fun to watch. So you want to tell us just really quick about you? So you got Dividend Stockpile, and we
Yeah,
know you're in Tampa. So
yeah,
how long have you been dividend investing for?
yeah, sure. Thanks again. So yeah,
Yeah.
in my spare time, I have a website. It's called dividendstockpile.com. I post valuation articles, insights into dividend investing, motivational type of material. So hopefully it helps everyone on their journey to building their dividend stockpile, and that's why I called it that.
I like it.
Outside of that, I'm married, family, 4 kids. You know, making things happen.
Four.
So
Yeesh.
yeah,
I love it. And it's
yeah.
funny. We were just talking about the kiddos, and you
Yeah.
have your kids invested in dividend stocks. And
Hmm.
a little more breaking news today. My wife and I were talking about the future, and I opened up another account for the kids, and I'm calling it the wedding account. Now, my daughters are 13 and 14. So
Okay.
the average age that women in the United States gets married, and I'm goofy, I looked this up, is 27. So we would like to pay for all of it, and if not all of it, at least a big chunk of it. So we're going to put $100 a month, $50 for each daughter into SCHD, which is the Schwab dividend fund ETF. Dividend ETF, yeah.
Hmm.
And it's a 0.06% expense ratio, so super small. They're kind of competing with Vanguard. And that's what we're going to do. So we're just putting that money into them, and hopefully it's going to compound and accumulate, and we'll have money for their wedding as well. So yeah, have you ever thought about weddings? How old are your kids, by the way, or
so
roughly?
yeah, so my kids are 12, 11, 6, and 9 months. So, but for me, I
Whoa.
have all boys. So hopefully, we'll see
You
if I need
got
to cover the weddings or not. But we definitely want them to get a leg up in life. So we're going to help them where we can, whether that's a wedding, a house, just their future.
Yeah,
Um,
you
we,
lucked
we
out,
want the
man.
best. We want the best for them, of course, and if we can make their lives easier by helping them out, and they don't have to go in debt for certain things, that's what we're here
Yep.
for. So I'm
Yep.
hopeful. Yeah, all boys on my side, so we'll see. We'll see about that whole wedding thing. So
Hey, yeah, that's kind of my rule of thumb, is I'm just trying to give them something that I didn't have. And I feel if I can leave them, if they can enter adulthood better than I entered adulthood, then I think I'm doing something right. So
absolutely.
let me get into this. So we've been looking at the stock futures, and we'll take a live look here at the stock futures and see what they're doing. Now I know that's been a turbulent week. I bought
Hmm.
my share of PepsiCo a bit early at 158, and it dropped 153s. And yeah, so it's looking like tomorrow we might start off. The Dow is up 220 points right now. We're 0.63%. S&P is up. Same, they're all about the same, 0.68. NASDAQ 0.63. So it looks like we're going to start green. And look at that. Oil is at 106 a barrel.
Yeah.
So hey, it looks like it might be a little bit better, smooth sailing tomorrow. So
Yeah.
um, this is
I was
great.
hoping. Yep.
You're not worried at all about Try prices drop, prices dropping. I can't talk. I'm
No,
missing like 2 hours of sleep.
I
Last
know.
night I went to a concert and I saw Doyle Wolfgang von Frankenstein. He used to play for the Misfits. So, wife and I were out a little bit late past our bedtime. So, anyway, and we'll get that sorted out with my mouth. So, yeah, prices dropping. Great opportunity. Am I right?
Yeah, absolutely. I was hoping to, make my buys for the week and get a good price, but hey, the money we already have invested, if it goes up, that's a great thing too. So as a dividend investor, you like it both ways. Lower prices mean you get better yield. Higher prices means you're making money. So we'll take it either way.
Yeah, yeah. I mean, it's just great. It's harder with prices going up. I mean, inflation is here. It's no secret.
Hmm.
I
Hmm.
think that's going to be a bigger deal than the war in Ukraine because we talked about it last time that I think Ukraine and Russia are like less than 3%. See, I don't have my numbers written down, but they're not a huge part of the world's economy, but they're a big enough part of the supply chain that just that disruption is kind of what's going to help throw a kink into things. And one thing I looked at found this interesting stat. I don't know if anybody reads John Malden out there. I would highly suggest his thoughts from the front line. It's a weekly newsletter from John Malden, just fantastic. And he pointed out in there that a 1 cent increase in gasoline that cost the U.S. economy $1.4 billion. So right now we're roughly about $200 billion of increase just on gasoline. So that's kind of like a tax increase to everyone, and that's going to have to come from somewhere. So it may get tighter for people. Do you think we're headed toward a recession, or do you think this is just going to be a blip in the grand
Yeah.
scheme of things?
I mean, I think with the Fed adjusting the monetary policy, I think with the personal savings rate that the population has had over the last few years, I think we can stave off a recession for the time being. It's going to be volatile. It's going to be painful in the short term, especially until the Russia-Ukraine thing ends up, and then a couple more quarters of seeing where the inflation is. But I see that things will spring back. I think there's a lot of liquidity, and I think there's a lot of money out there waiting to invest. And so I think most investors, once the coast is clear, if you will, I think we'll see money start pumping back in. I think there's just a lot of uncertainty right now. So we'll see how things go. You never know.
And boy, investors hate uncertainty, don't they? So that's why I thought it was interesting after they announced the rate hikes. It didn't seem to really affect it that much because, I think you said it in your blog. I was reading that that's what we love. We love certainty. Investors love certainty, so they want to know what they're dealing with. And companies, right? They want to be able to plan out for these increases. Let's see. I
Definitely.
don't know if we should get into comments yet. Maybe wait a little bit. We'll get back to them.
Okay.
Um, we could just we were going to talk about some stuff we're buying, so why don't we just get into that right away, and then we'll tackle a few of the questions and we'll see where it goes. Uh, I'll just start out really quick that I'm looking at companies that have pricing power and pretty
Mhm.
decent balance sheets, and I think some investors might hide out there. And again, companies I think like PepsiCo, while I still think they're starting to come down in price. And oh, by the way, you're well aware of my share a week for 100
Yes.
week. So I've got
Yep.
going on, which it was painful. I won't lie. And I wanted to do it just so I could have this experience for the rest of my life and say I bought a share of a blue chip company for once a week for 100 weeks. And when I'll be honest, when I was buying at 176, I think was the highest. I know when I bought, I said if I wasn't doing this, there's no way I would have bought here.
Yeah.
But I also said that when it was at 141 or 142. So it just it's kind of cool, and I'm excited to see in 10 years where Pepsi's at. And I have a feeling when they're probably over $200 a share, it's not going to feel that bad. Yeah. So what do you look for? I'll let you shoot out one. So there's one of mine, PepsiCo. What is something, could be ETF, anything. What's something that feel comfortable buying right now?
Absolutely. So in past years, I was focusing mostly on individual companies. So of course, Pepsi, Johnson and Johnson, Procter and Gamble. I have 50 plus different individual companies throughout my portfolios. So I was always focused on individuals. But as the prices went up on across the board on most of the stocks over the last few years, I started really thinking, maybe we're a little high right now. So I changed my focus for 2022, and I'm actually focusing only on ETFs and closed-end funds this year.
Really?
So um, I've always had ETFs and closed-end funds, but it was never high allocation, and so that's what I'm focusing on this year. So one of the big ones that I've been doing this year is an international dividend fund, VYMI, the Vanguard International Dividend ETF. So that's one that I buy on a weekly basis, week in, week out. Doesn't matter what the price is. I put some money in there every single week. I need to increase my allocation internationally, and VYM has 1,200 different holdings, so it takes a little bit of the edge off of trying to find the right company at the right price. I can just buy that, get my exposure, and move on with my week.
Yeah, I really like that. That is, and it's funny because as I'm busy and some weeks I'm really busy with work and I just don't have the time to do the research that I would like to do. And it's just so nice to buy that basket of stocks. And I understand people say you're buying also stuff you might not normally buy,
Mm-hmm.
but I mean, like, I just actually initiated a position this week into URNM because I think uranium is the green energy of the future, and there's 35 companies in that. But the main reason that I really wanted to do it was Kazatomprom is Kazakhstan, which is where Borat Sagadiyev is from. I love Borat, by the way.
Yeah,
But yeah, anyway, so you
mm-hmm.
can't buy Kazatomprom on the U.S. exchange, as I found out. You'd have to go through the London Stock Exchange, and already I'm like, I don't know how I'm going to do that. So I started looking into ETFs, and I found URNM. It's their number two holding of Kazatomprom, which in 2019 or 2020 was responsible for I think 40% of the world's uranium. And it's just so cool to just have that instant exposure with one shot. You don't even have to think about it. You're just getting that
Exactly.
exposure.
Yeah,
And it's
and
funny you say that. Yeah.
it diversifies your risk, because as we know, any one company could go to zero, but a basket of companies, you have a better chance of not having that happen.
Yeah.
So especially if you're not sure which of the companies is going to be the winner or the leader in the space, sometimes a basket approach is the way to go. And so an
Yeah.
ETF like the one you mentioned is a perfect way if you want to get exposure to a certain sector or a certain country or whatever.
Yeah, I think it's great, and I know a lot of people on Twitter, and you see people go back and forth like between your ETF or individuals only,
Mm-hmm.
and man, both. I think both is
Exactly.
just fine.
Absolutely. Do both. Focus your core of your portfolio, maybe in some ETFs, some broad-based ETFs, and then pick the companies you really want to focus on, whether that's Pepsi, Johnson & Johnson, 3M, whatever it is that you like to focus on or you want to be a part of that company's future. Add some individual allocation. There's nothing wrong with doing both.
Absolutely, absolutely. All right. Well, let's see. So you got VYMI. I'll just throw out one more. I bought some more Clorox this week because I think they have some. I know Ian Lopic, PPC Ian, shout out, did a video on
Right.
Clorox, and I agree with him. I think there's going to be some choppy waters ahead, but
Mm-hmm.
ultimately, I think they're just big enough and solid enough, and they're going to be able to pull through it. But right now there's a lot of volatility, but their dividend yield is I think 36% above the 5-year average. So one thing I found with dividend stocks is a lot of them seem to have in that price protection, that downward price protection, because a big blue chip company, I mean, I can't imagine Clorox being at a 5% yield and nobody buying. So they get
Exactly.
to a point where that yield starts getting high enough and people are like, okay, I can't pass up this yield on this company. And then when they do that, more people start buying and it kind of helps reverse it and turn the company around, or
Absolutely.
turn the stock price, not the company around. But that's a funny thing too. I'm blabbling on here. When the stock market drops, always remember that doesn't mean that company. So if PepsiCo were to drop in stock price, I don't know, 20%, which would be nuts in the market, it doesn't mean that the company is is 20% less valuable, I guess, in my opinion. Maybe I'm not
Absolutely.
saying that right. How would you say that? Not
No,
value.
that's exactly right. Price is what you pay, value is what you get. That's one very famous Warren Buffett quote. Another one that he's really famous for saying is that in the short term, the market is a voting machine, and in the long term is a weighing machine. So the current price of a stock can go up and down depending on investor sentiment. But in the long run, the prices track the fundamentals. And for a company like Pepsi or Clorox,
Yep.
eventually the price will follow what the company does. And I like Clorox too. I think it has a great future, has a great suite of brands that they're part of. And I mean, they're in part of everyone's household. So I don't think that one's going anywhere. And I don't think that we as dividend investors need to be worried about it.
No, no, absolutely not. All right, let's tackle a few of these.
Okay.
I'll just run through them. I'll pop them up there. I think you can see them. Blue collar bill. Yeah, said SCHD is a great ETF. Should work well. So, well, Bill, I'm probably going to be buying. I'm, I'll share this too. I guess I probably do a video in the future on this. Then we'll look at the kid's wedding fund to see what it looks like. Just solely buying that. Oh, and also as I was talking to my wife, I would feel much less attached because my problem is that I buy and I fall in love with what I buy, which is a good and a bad thing. But
Mm-hmm.
I think I would have an easier time parting ways with if I needed to dump 10% of SCHD or something, just because it's not as personal as that singular company. So
Absolutely.
yeah,
And that's not a bad thing because sometimes you need to step away from your investments in order to become a long term investor. If you're sitting there looking at the price every day or wondering what's going to happen with the company next week or next quarter, if you're stressing yourself out over that, maybe the solution is to take a step back, get a broad basket of stocks, and just move on with your life. It's
yeah,
going to be working in the background for you. It's going as managers that adjust as companies get stronger or weaker, and over time, something
yeah,
like SCHD has done extremely well. I think the 10-year compounded annual growth rate is around 14% for that ETF. So I mean, that's a very solid return. Plus, a 3% ish dividend. I don't think you
right.
can go wrong with something like that.
Right. Yeah. Yeah. So I'll let you take this from Ryan if you want. Is it better to buy a S&P 500 index fund or an ETF like SCHD if you're trying to live off dividends someday?
Sure. I think I'm going to be a little biased here because I am a dividend investor. So SCHD would be my choice. So if you're focused on dividends, you want to look at what kind of yield or what kind of income you're going to get from an ETF. The S&P 500, obviously, as the name says, is 500 stocks approximately, but not all of them pay dividends. And so the combined yield of all 500 stocks, I think, is around 1.4, 1.3% yield right now. So in order to live off that, you would have to have a substantial portfolio. So if you focus on something like SCHD, you still get the diversification that you need because it has about 105 holdings and it's top quality companies. We're not talking about the bottom of the barrel companies here.
Yep.
And you're going to get around a 3% yield. So, you're over doubling the yield of the S&P 500 and you're getting the dividend growth and you're getting a great return every year. I've looked at previous reports of their returns over time, and they track pretty closely to the S&P 500 over time. So if you are a dividend investor, I would definitely focus on something that can pay you, higher dividend than maybe the S&P 500. But obviously, S&P 500 is the benchmark. That's what what the United States, at least, market is focused on. So there's absolutely nothing wrong. You gain 500 of the strongest companies in America, and at the end of the day, over a long time period, you can't go wrong with either.
Yeah, and I'll add on top of that, if you're trying to live off dividends, you really don't want to have to touch the principal. You just want to live off the interest. So it's a lot harder to do that. You need a lot more,
Mm-hmm.
even though like the SPY might have, I don't know, it might have more growth. But if you're doing like we're doing, where you just want the dividends, you don't want to have to touch and eat into that principle. Yeah, I would easily say SCHD, and also look at Vanguard has a few different funds, and Schwab has their Fidelity. I think has one. Um, yeah, there's a whole mess of them out there. All
Yeah.
right, Vin, what's up, Vin? Here we go. With Amazon announcing a split, do you think they might start paying a dividend in the near future?
That's
I don't
that's a
know. I'll let you. What's your opinion? I'll give mine.
Sure. Um, I don't think they will in the near future. I think they really still are in growth mode, especially with AWS, their server division, if you will, their cloud computing division. They're pumping money into that to grow it, and they're also doing a lot of things like the cashierless stores that they're trying to open up, and next day, same day shipping. So they're spending a lot of money to create a better service for their customers. So I really don't see them using their excess cash right now for a dividend, but they are a cash flowing machine. So I think over time, the farther distant future, I definitely could see them paying a dividend, and I think that would open up the the shareholder base of Amazon if they did start paying a dividend.
Ugh,
Even if you got a
that's
one
a
and a half, 2% dividend, I think that would be a really good combo. But in the short term, no, I don't see it happening personally.
yeah, and that's a scary thought that Amazon is still focused on growth with how big they are. I mean,
Yeah.
it's yeah. So yeah, I'm with you, and I think once they do start, it'll be pretty small, but they'll probably do like Apple. They'll have bigger increases, and it'll just increase forever until they go out of business because they're not, they'll easily be able to pay it.
Yeah.
This is one. Don't know how to say her name. On Fam is
Mhm.
Whirlpool a good dividend stock? There was another YouTuber that Ryan Williams introduced me to. He popped on last time. He did a video on Whirlpool, and I know he really loves Whirlpool. And actually, yeah, I'll talk here for a second. I'll pull up here. Why don't we'll go to Simply Safe Dividends and see what score they give them. I can pull that up here.
Simply Safe
Share the
Dividends is a great
screen.
website, so I definitely recommend it.
Yeah.
Oh,
Do you remember Whirlpool? Here, I'll type it in.
no.
WHR. There we go. All right. So they give them a dividend safety score of 70. So that's safe. Dividend growth 25% is their last hike, 3.78%. Let's scroll down just a minute. They did a note on them that was May of 2020. I wouldn't bother with that. That's a bit old. Let's see. They maintained the dividend during the recession, the 31 years without a reduction. And we'll just take a quick look at their 11 years of growth, $1.75 a share. The dividend yield it says it's 35% above the 5-year average. And the PE, the forward PE is below. Oh, check that out. Their 52-week price range, they are buried all the way to the left. So that's free cash flow payout ratio is only 20%. Are you kidding me? Yeah, I mean, just right away, this looks pretty good. Free cash flow, $26 per share. Sales growth steady for right now, and they are buying back shares, although it looks like it may have tapered off a bit. Yeah, sales are going up. I'd give it a thumbs up. What do you think about Whirlpool?
Yeah, so I don't have it personally. I never have. I haven't done a ton of research. Obviously, I know the company, seen their products. The metrics look great. My only concern is one is the supply chain and how they're managing
Mhm.
that, and second is competition. When you go into your local Best Buy or your Home Depots to look
Yep.
for appliances, is Whirlpool really at the top of your list? You have LG, you have Samsung, you have all these other companies. So I'm just not sure what their mode is, if it's something they can sustain. So
That's
I don't have it personally, but the metrics look great. So you definitely dig into it, and see what you think.
Yeah, on the metrics, and see, this is why I love having you on, man. That's a great point because thinking about my house, we have Samsung. We
Hmm.
have a Samsung washer and dryer, and I know we don't have a Whirlpool dishwasher. Can't think of who it is. It might be Maytag.
Hmm.
Um, yeah, so right there. Do you have any Whirlpool appliances that you know of?
We don't. No, we have GE washer and dryer and a Samsung fridge, and couldn't tell you the dishwasher, but it's definitely not Whirlpool. So
Yeah, yeah.
that's
Same
my
thing with the
yeah.
Yeah, so look at that. That's 0 for 2. So right here, that's a small little snapshot. Two households, and we don't have any Whirlpool appliances. So I know they probably have some other things that they do other than just the washers and dryers and fridges. But yeah, interesting. So I'd say dig into it a little more. It
Mhm.
looks good, but as dividend investors, we kind of want to try and look forward as much as we can, and that's the problem with a lot of the metrics as they are backward looking.
Mhm.
All right, we'll just go through a few of these. Blue collar Bill enjoyed the stream so far. All right, Bill, have fun at work.
I actually follow Bill on Twitter, so if anyone's
Yeah,
interested in,
same here. Yeah.
yeah, so if anyone's interested in another person trying to build up their dividend profile and live off the dividends, he's a good one to follow.
Yeah. And he also wants to know he has 40 stocks. Should he trim that down? How much diversification? I've heard a rule of thumb that you should have 20 to 40
Hmm.
ish, and you shouldn't over allocate to any one sector and any one stock. I know 10% is kind of the max you should put in any one stock, they say, but more like 5% is probably better.
Hmm.
I don't, that's a personal question. I don't know if you can keep track of all of them. And if you can't keep track of them or you don't sleep well at night, then probably trim it down or start looking into ETFs.
Yeah, absolutely. I'd like to add a little something there.
Mhm.
So I'm a big proponent of diversification, and to your point, Russ, the typical guidance is somewhere in the 18 to 35, 20 to 40 type of stocks, depending on your needs.
Yep.
But as a dividend investor, you might want to consider a different approach. We are here to live off the dividends, and so dividend safety and our income stream that we get from the dividends is very important to maintain. And if I was to only have 10 dividend stocks and one cuts their dividend, I just lost 10% of my income.
Great
If
point.
I have
Yeah.
20, I lose 5%. But if I have 100 stocks, I might lose 1%. That's something I can live with. Or even 50 stocks, I'm losing 2% of my income. So as a
Yeah.
dividend investor, you might want to consider a broader diversification than you would if you were a growth investor. So, but as Russ said, it's really what you feel comfortable with and what you can manage and how well you sleep at night. I definitely agree with that.
That's
My
Jason Fieber. Jason Fieber,
Mhm.
he shares he has well over 100
Yeah. Hmm.
stocks. And yeah, I mean, I guess played out in your head is go worst case scenario. Try and imagine any one company or a couple just completely eliminating their dividend. How would that affect you? And if it's too negative, then you might need to diversify more, like Jeremy said.
Yeah, absolutely. And my personal guidance is I don't want any more than 5% in any one holding and no
Mhm.
more than 15% in any one sector of the economy. So that's how I personally keep track of my allocation and my diversification is I'd rather spread out my bets, if you will.
I like it. All right, let's get to Ryan's question here. Let's see. How can I save for a house with putting it in cash and losing 8% to inflation and with houses going up 20%? Well, I guess the only thing I would say with that is if you need the money within what 3 years, maybe that's was that what they say? I'm
Yeah.
on the Bogle heads. They have a
Hmm.
really cool forum, and I know a lot of the people there. They said have that rule of thumb: 3 years. If you need that money any sooner than 3 years, don't put it in the market. Um, yeah, with that one, that's a tough one.
It
Uh,
is. And I feel bad for, anyone trying to get into the housing market today because, prices are, skyrocketing up and it's hard to know how
yeah,
much longer that will last. But with the housing shortage around the country and everyone looking to buy a house, I don't expect the prices to level off anytime soon. So it is a very difficult thing. And I feel for anyone who's trying to do that. But I 100% agree. If you need the money within the next 3 to 5 years, you really can't risk putting it in the market.
no,
How would you
no.
feel if you were looking to buy a house and March 2020 came around and you just lost 30% of your savings that you were going to buy a house? Like, how long would
Yeah.
that delay you? So you have to really consider the risk of investing your money when you have a specific goal and need for that money.
Yeah, and to add on that too, the next March 2020 might not rebound as fast. What if it took,
Mhm.
16 months to rebound that and you really need or want to buy a house? And then it
Absolutely.
might take longer coming out of that. So it could take quite some time. Like this was just so unusual what we saw.
Mhm.
Yeah,
I
so with
mean,
that, again, I would go into a FDIC insured,
mhm.
savings account. Just take your little bit of cash, and that 8%, that's going to come down. I don't think that's going to be like that for a long time. Even you look at the 1970s, it didn't stick around like that for a decade or something. At least I don't think, from what I remember.
Yeah. Another
Uh,
thing to consider is
yep.
from 2001 to 2010, the Nasdaq didn't make any money. So
That's right. Yeah.
expecting the market to come back in enough time, like it did in 2020, to make your money back, it may not happen. I've been investing since 1999, and there's been plenty of times where 40% losses, 30% losses on a regular basis, and it takes a while sometimes for it to come back. Sometimes multiple years. And if you're willing to
Yeah.
wait on your house purchase, that's one thing. But if you have a goal and a plan, I would stay out of the market without money.
Yeah, I love it. Real quick here. Cool little story. David tells his son it's his dividend orchard. Each tree is raised with he'll eat the apples one day, but won't chop down the tree. That's what we were saying. It's
I love it.
perfect way of saying, yeah, don't eat into the principal if you don't have to. Live off the interest. Let's see. Oh, that's right. Steve, I apologize. I didn't do Gilead. Um, yeah, I'll pull it up on Simply Safe Dividends. I do have a small position in in Gilead. Here, let me start.
Yeah,
Do you
well,
own any Gilead,
I do.
Jeremy?
I have a small amount. I've owned it for many, many years. I like their HIV drug business that they're working on, but the market really hasn't appreciated what Gilead can do. It's been a struggle holding on to that one for as long as I have. But I do have a
Yeah.
small
Yeah.
position. It's probably 1% or less of my portfolio.
All right, and here we are. So it is. They give them a dividend safety score of 70, but look at that yield. See, I haven't even looked at this in a minute. That yield is now over 5%. Wow, I might
Mm.
actually add a few more shares of this. Yeah, dividend growth only 2.8%, so it's pretty slow.
Yeah.
Uh, yeah, you can see right there my average 11 shares at 65.60. So it's a really really small position. But yeah, my yield on cost is 4.45. So I can actually be pushing up my yield on cost if I buy right now. And yeah, they've 6 years of dividend growth uninterrupted. So yeah, that's pretty interesting that their dividends 34%. Right here it says above the 5 year average. And the PE is 8.9, which is the 5 year average of 10.0. And there it is again, another stock that's buried all the way to the left. And I always love looking at the free cash flow. That looks good, 33% ratio. So yeah, the low earnings per share, kind of steady. Sales growth only 11%. Yeah, and they're a buying back share. Oh no, they haven't. They haven't bought any back since 2021. So yeah,
Yeah.
I don't know. I like
Yeah.
it. I actually think I might be adding more. And one thing that I did read was that one of their problems is they actually cure. I think it was their what do you remember what medicine it was? I don't remember that they cured too many people, so it's like great for humanity but bad for the business that they're
Yeah,
curing too many
I've
people.
heard that as well. I don't recall which drug it is, but I mean, as you said, it's great for humanity that they're doing this. But
Yeah.
if there's no illness and no sickness, I mean, they're a pharmaceutical company at the end of the day, so something to consider. I mean,
All
I
right.
think there's stronger names in the pharmaceutical
Mhm.
space, but it's a solid player. It's a great dividend. Stable as she goes type of thing.
Yeah, yeah. KitchenAid is part of Whirlpool. Thank you, An. I hope I'm saying your name right, An. And young dividend investor says that they own Maytag, so I did not know that. So that's yeah, that makes sense. Let's see. Here's one. Trayvon, what about PM stock? Has dropped a lot because of the war. Yeah, I we talked about Philip Morris that they have, I believe they had an 8% revenue exposure in. Yeah, I'm trying to remember. I think they have a 8% revenue exposure to Russia and Ukraine, which I think was the most of any S&P 500 company, if I remember going
Wow.
back a week, right? So that's probably one of the reasons why they're dropping. But I think over the long run they'll be fine, and they are more of an international company than Ultra. They did split off of right. They split off of Altria.
That's correct. Yeah.
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 Uh,
It's a cash flowing machine again. They have pricing power with their products. They have global exposure. So, I mean, I don't invest in Philip Morris or any of
yeah,
the
I don't
tobacco
either.
companies just out of a personal preference. But if you can get past, the products that they sell and you're okay with that, it's been a long-term winner for most dividend investors. So definitely take a look, but it's just not for me.
Yeah, I own Altria, and I started a position in British American Tobacco (BTI). And Altria, I believe, is 100% either North America or just United States exposure.
Mhm.
So there's really no international exposure with Altria. So that's why I kind of went into British American Tobacco. And yeah, it's a lot of the sin stocks. I know people have issues with them, and that's fine. That's why personal finance, your own preference. But yeah, I think they'll be okay. And I know the industry is shifting. And if I know from doing Altria that they are shifting into the heat, not burn. They want to
Mhm.
get away from the combustibles. They're moving into like nicotine pouches, which is pretty interesting that there's no tobacco in it. It's just nicotine. And from what I understand, is that nicotine is non carcinogenic. So the industry is shifting. It's just going to take a minute. And yeah, I see less people smoking anyway. Nasty habit. I feel for anybody that smokes. And no offense if you do smoke, but um, yeah.
Yeah.
Anyway, so this one, yes. Travis, do you guys use covered calls on dividend stocks for extra money? I do. And if you watched last week, you'll know I had some Altria shares called away, but I sold a cash secured put, and I got the dividend as I did the on the podcast 52 days in advance. I my little bit of imagination, but yeah, covered calls. You do covered calls too, don't you?
I do. Yeah, I do significant amount of covered calls and cash secure puts as well. I on my blog I joke that it's jet fuel for dividend investors.
Oh,
So you can easily double your dividend, if not more, by writing covered calls. There's a lot of great strategies out there, but yeah, I absolutely do it. It adds hundreds, if not thousands, of dollars each year to my available investments, so I can buy more dividend stocks.
do you get bit with the greedy bug like I do? I'm still trying to work through that because I say like PepsiCo, that's why I'm going for 100, and
Mhm.
immediately I say, okay, I don't want to really lose these shares because I did a lot of work to get them, so I'm going to write these way out of the money and just pick up a few bucks. But then you look at the options chain and you start seeing like, like you could get more and more money the closer you go to it being in that,
Absolutely.
and it's just something I'm struggling with where I'm going to have to say, okay, I'll just take the whatever $10 or $18 I'll
Mhm.
get for a couple weeks and not have to worry about PepsiCo jumping 10% and getting called away.
Yeah.
Um, yeah, so we love them. Great point. Let's see, Steve. It says buy a house and get a renter to help you pay your mortgage. I think Graham Stephan did that. I think
Yeah.
he bought a duplex and he lived in one side of it, and I think his tenant paid for everything. So is his
Yeah.
house hacking for free? Let's see. I love it. All these questions. Great. I'll do this all night. What's your opinion on MetaFast? I don't know about MetaFast. Do you? That's one that I'm not familiar. I haven't looked into.
Yeah, I've had a couple of people ask me to do some research on it, and eventually I will. But it's not something that I'm interested in, and I haven't really dug into the details. But yeah, I don't really know much about them.
We'll just see what they're. I'm looking up. They give. Here, I'll share it. Simply Safe Dividends has a. Sorry, I'm talking and doing 17 things at once. They have a dividend safety score of 45, so that's borderline safe. So I'm really enjoying Simply Safe Dividends for this. It's nice. It really helps out. With us that are busy, and it's a great service. It's a little bit. Yeah, see, I don't know if they can keep this up. 40% last 5 years growth, 6 years uninterrupted. So I'd have to dig into it more. Um, Oof. Yeah. Free cash flow to 110% payout ratio. So that's probably why they're getting that borderline. I don't know what happened. There might have been an acquisition or something there that did that to bring it up like that. Like CVS, right? CVS, when they acquired Aetna, that they froze their dividend so they could
Mhm.
start paying that down, and now they increased their dividend for the first time in 5 years. So I'd have to look. They might have made an acquisition, and now that's why that's so far up there. VFC, they own Vans, I believe, right?
Mhm.
VF Corporation.
Yep.
Ryan Williams did a video on them. He likes them. He's buying them. I don't own them outright. What are your thoughts on VFC?
Yeah, they have a great history. I think they've done raise their dividend a very long time, and for a clothing related company, that's actually quite impressive because it's a very tough market to be in. But they do have some really great brands. I believe they own the North Face as well, so it's quite a collection of brands. But I don't own it personally, and the industry doesn't really appeal to me, so I'm not going to be buying anything there.
Yeah, that's a weird one. Textiles, right? That they should do well during recessions because I mean we need to wear clothes, but if money's tight, hey, people
Mhm.
might be going to Goodwill and secondhand, thrift stores instead of the brand new places.
Absolutely.
Yeah, let's see. He owns Gilead long term play. Let's see. All right, there we go. Nice, easy one. Wendy. Hey, there she is. Sending good wishes to you and yours. Anybody that's on Twitter, all right, you follow Wendy, right? Her L Wifer, I think, is her. She's all over the world. Really cool person. So, what is up, Wendy? If you're watching, this might be more in your ballpark. He's from Texas. What's your opinion on ETFs like DIVO, JEPI, and BST?
Yeah, I own all of them. I think they're great. So for those who may not be aware, Devo is a dividend ETF, but they sell covered calls on part of the holdings, and so that gives you quite a good dividend. Right now, the dividend is just shy of 5%. So you get the dividends from their holdings, plus you get the income that they collect from doing the covered calls, and you still get the upside because they only do a certain percentage of their holdings as covered calls. So you still have some of the upside, but you get some of the income today. So I love it. It's actually one that I add every single week. I do 15% of my weekly allocation. I put into Devo. So I'm a big
Wow.
fan.
Wow.
JEPI is another covered call ETF, but they have a different focus. They focus on lower volatility S&P 500 fund companies, and then they write covered calls on that as well. They do a higher percentage of allocation to covered calls, so you don't get as much upside. But the income is great. I think it's somewhere in the 7 or 8% dividend right now. It's quite high.
Wow.
And then BST is actually a closed-end fund, so it's a little different than an ETF. They do have higher expense ratios, but it is a managed fund, so they can invest in a variety of things. So BST itself is a technology and science fund, so they focus on NASDAQ type of companies. And they also do cover calls on that one as well, so that helps boost up the yield. They actually have a great dividend increase history, and a great yield is somewhere over 7% right now. So that's another one that I'm adding to every week right now is BST.
So I have a question about the covered call ETFs.
Mhm.
Has there any back testing for during? Well, they haven't been around for during recessionary times, right? Because obviously, if the market is stagnant, I always wonder how that works. So wherever their averages are, so premiums are going to start drying up as the market's falling, right? Am I wrong on that, or do you know a little
Dep-
bit about the mechanics of how that works?
yeah, so it depends on their exposure. So if they own a company that's underwater, the prices come down a lot, and they're not going to get as much income from writing covered calls because the closer you are to the strike price, the higher your income is from the covered call. I believe that they turn over pretty quickly, so I don't believe that they hold on to their holdings for
No.
very long term. So they might be able to ride the market down. It is a managed fund, so you have a group of investment professionals that are looking at it every day and feeling out the market. So I feel comfortable with them as things go down. But yeah, so volatility makes a big difference on how much they can do cover calls. So if the market is going up and down a lot, they can take advantage of that. But if it's a flat market, they're not going to get as much premium. So it could affect it on a yearly basis. BST is interesting because they have a managed payout. So the dividend you receive every month is steady from year to
Mhm.
year, and it doesn't matter if they're doing a lot of income that month or a little income, you get the same dividend every month. So that's pretty cool.
Oh.
And the advisors adjust that every year depending on how they feel that they can do.
So now you talk about jet fuel. Would it be rocket fuel if you own 100 shares of Devo and sold covered calls on the covered call ETF?
I would have to look into it. I don't. I'm sure that there is options
Can you
available
even do it? I
for
don't even know.
it. Yeah, I'd have to look into that one. I've never done it myself.
But yeah, all right. See, I love this. Like that's what I'm. I was telling him before we. I was telling Jeremy before we started that I got like a little a little outline. Okay, we'll talk about this, and then I was like, dude, but then questions come in, and I get off track, and I just want to like talk with everybody. So, Aaron says, for a portfolio in its early stages, would you suggest using the drip approach or receive the dividend and manually focus on building a position on one specific stock faster? I'll answer that quick. For an early stage, it probably would be better if you're a newer investor to just drip and not have to worry about it. You'll automatically buy less shares at higher prices and more shares at discounted prices. And you just set it, forget it. You don't have to worry about it. But for me personally, I joke around that I collect the dividends and then I cut them with new cash and then
Hmm.
I target allocate into something like I might do. Actually, I just received several dividends from I think ExxonMobil, J&J, and I'd have to look one more 3M. So
Hmm.
I might probably target allocate those into maybe a share or two of Gilead, just because I think that looks pretty good. So, what's your opinion, Jeremy?
Yeah, so for drip, I do it. I would say half and half. So half of the stocks I own, I drip. The other ones, I collect the dividends, like you were saying, and allocate them to either undervalued positions or positions looking to grow. For a beginning investor, I definitely recommend drip. It's really about setting up a program and a process that you go through. And also, if you don't drip, you're doing a little bit of market timing, and that's really hard to keep up with. So sometimes, especially as you're building out your portfolio, it's better to just let the dividends reinvest. You get more shares, which then gives you more income, and it gets the snowball rolling. Once you get to a certain allocation, like if you've decided that this particular position you don't want to get any more than 5% of your portfolio, maybe once you get to the 5%, you turn off the drip and allocate the money elsewhere. So I do a little bit of a combination of both.
Yeah, my daughter's in their custodial account on Schwab. It's just a toggle it on,
Hmm.
toggle it off. Super
Yep.
easy to drip them, and yeah, I drip all their dividend stocks. And my one daughter has Walmart. It's fun. I show them, trying to get them into it. Teenage
Hmm.
girls. Go figure. A 14-year-old girl really isn't that interested in Walmart dripping, but nevertheless, I'm at least showing them they're, just look, I'm like, you didn't have to do anything else. And it automatically bought you, whatever 0.26 shares of Walmart, just
Hmm.
like that. So yeah, dripping's good. Trevon says, what about Unilever stock? Unilever, I almost bought a little bit more this week. I think they're going to be fine. I know they were getting a little goofy there with trying to acquire it was a GlaxoSmithKline's consumer health segment, and I think they
Yeah.
were overpaying for it, and the market pretty much had a fit about it. So,
Yeah. Yeah, so I have Unilever as well. I think it's a great stable compounder. They have great brands. It's an international company, so that's nice. But you get some exposure mainly to Europe, but they have products and operations all over the world. I have read some details about the management team. Uh, a lot of investors are frustrated with the management team based on some of their decisions over the last few years. So I do believe it's a company with some short-term headwinds, but long-term, yeah, I'm very happy and perfectly fine keeping my shares and letting it drip.
yeah, yeah, perfect. Phil, what's up, Phil? Any stocks you don't own that you are monitoring closely? Yeah, I mean, there's always a slew of them. One of them for me is T Rowe Price, ticker
Mm,
TROW. They keep popping up on my screeners, on my radar, on
mm,
watch lists. I keep seeing them all over the place, and I might pick up a share or two and start a position. And just really quick before you answer, it just pops in my head. What's so nice about ETFs and this on the board behind me is the bridge portfolio. I wanted to start a dividend portfolio to talk about on the channel and share. But through my work, my 401k, thankfully, I'm able to invest and pick Vanguard funds.
mm.
So I invest already in T Rowe Price through them, which is it's such a nice feeling to know that I'm already invested in them. But for this bridge portfolio, I've been looking at grabbing a share or two. What about you, Jeremy?
Yeah, I think it's a great company. I have a relatively large position in them.
Oh,
I like,
really?
yeah,
Really?
yeah, and it's a great price right now. If you look at all the valuation metrics, it always comes up on my radar as undervalued across the board. On my blog, I do a weekly post on undervalued dividend stocks for the week, and T Rowe Price has been on there for multiple weeks now, so it's a good time to take a look at it.
Actually, while you're talking here, I should have did this while you were talking. I'm talking. I thought I'd bring up your website here real quick. Uh, oh, dummy! I'm gonna have to share my screen to do that. I'm like, like, oh, look at how great this looks. Oh, nobody's able to see it right now. There we go. All right, there we go. So always make sure check out his dividendstockpile.com. And there you go. Undervalued dividend growth stocks to research this week.
Yep.
And yeah,
So
maybe
I
it's a
have
little.
I have a tracker of about 130 companies that I follow on a weekly basis, and I do valuation calculations each time. And right now, there's about 27 of those 130 that are undervalued on multiple valuation metrics. So yeah, definitely take a look, see if any interest you. It certainly is a starting point. Don't buy something just because it looks undervalued. Make sure you understand the company and you like their fundamentals and their growth prospects. An undervalued company that continues to lose business is not a good buy. But if they are temporarily undervalued based on what's going on in the market, but the underlying fundamentals are still good, it's a great time to pick up some of these companies. But definitely do your
Yeah.
research first.
Fantastic. Yeah. Make sure you check out dividendstockpile.com. Um, yeah. So what do we got here? Yeah. So that's what we're monitoring. Where are we at?
Oh yeah,
I
so
lost my
monitoring.
space.
The one that's always popping up on my radar that I don't own yet, but I'm very interested in,
Hmm.
is actually a Canadian company. It's Manulife Financial, stock ticker MFC. So it has a great dividend, solid business, but the only thing that's holding me back right now is the historical price track. It's really not done much in the last 5 years. So at the end of the day, we're dividend investors. We're looking for the dividend, but we also want some capital appreciation as well. So that's the only thing holding me back right now, but it's always on my radar.
Nice. I did see them pop up, or somebody mentioned them. We have Shamir. He's not with us. I think he talked about them. He's from Canada. What price would you buy McDonald's and Costco at? Oof. Well, McDonald's, I'm hoping that comes down a little more. I wished I would have bought more when it was under 200. And I did have a note here that they suspended all of their operations. I think 800 or 850 stores in Russia, just, I guess, leaving them. And that is going to cost them about $50 million a month currently. So, not a crazy for how big McDonald's is, but it's something. I mean, that's nothing to sneeze at, 50 mil. And what price? So I don't own any Costco. It seems perennially overvalued for me, but they're such a great company.
Yeah.
McDonald's, I'm looking for under 200 personally, maybe around even closer to 190 would be awesome. I don't know if we'll get there. What about you? Do you own either Costco or McDonald's,
Um,
or any
I I
words of
own a
wisdom?
very small I own a very small position in both. So I have two portfolios. One's with Fidelity Investments and one's with M1 Finance. And so my
Hmm.
M1 Finance is one of my smaller accounts, and I do have both of those holdings in that. I just dollar cost average every 2 weeks. I put a little bit of money in that account, just let it do its thing. So I do have a very small position, but they're not anywhere near my top holdings. Costco is, it's a great company, but to your point, it's always seems like it's overvalued. So you really
Because
have to be
it's
in it for
yeah,
the long term.
it's just such a great company, and that's kind of another benefit of finding great dividend stocks, because they're usually mature, successful companies, which people are going to want to keep holding them.
Yeah.
Makes it easy. Let's see. And again, says the 3M lawsuits. Yeah, it's definitely a concern. I did a couple videos on it, and we're going to have to let it play out. I don't think all of those people that are in the lawsuit are going to get paid. I think there's a lot of people and a lot of lawyers looking for a payday in this, but um, yeah, I don't know. We're just going to have to see how it plays out. I know, like in my video, I said that 3M is trying to use the government contractor defense, meaning that they built a product that the government wanted, the government accepted it. They told them of some of the defects, and or some, they wanted the earplugs to be a quarter of an inch shorter, and they said it's going to affect uh, the operability of it. So they told them what they might have to do, and so it's a whole thing. And this is why we have the courts. This is what it's going to play out for. But it's definitely a concern, and they could be paying quite a bit of money, which is why we were seeing 3M drop. Let's see. He agrees with us on T row. Let's see. Oh, dividend capture strategy. You want to take this one? What do you think about dividend capture?
Um, yeah, I definitely do not recommend it. It's to be polite, I think it's a get rich quick scheme. It doesn't always work out the way you expect it to, and if it did work out, everyone would be doing it. But the fundamentals behind it is once the dividend is paid out, the value or the price of that dividend actually gets reduced from the share price. So at an immediate basis, you're at a net zero position. You get the dividend, but the stock price goes down temporarily. So dividend capture, you think you're grabbing the dividend as free money, but it doesn't work out that way most times. So I would not recommend it, and it's not something that most in the dividend community participate in.
Yeah, and then there's also short-term capital gains taxes if you're
Hmm.
getting in and out that quick. So yeah, it's something I've never done, and I wouldn't look into it. Let's see. We'll not go too much longer. I want to keep these right around an hour, and we're at what 55 minutes. Let's see. Let's here's a good one. Morton Matt, not worried about paying the taxes on the dividends in the bridge. No, because it's still a gain, and they're all. Um, I'm just holding these forever. I max out the Roth, and this is basically just overflow. So I max out our through my 401k through my work. So this is all just extra gravy money, I guess, and something we're building that just help pay some bills in the future. Maybe in the next 8, 9 years, uh, whatever, we can get $1,000 a month out of it. So I'm not that worried about paying extra taxes on it. Let's see. Touch on a couple of these. Steve also says BGS Foods went the wrong way for me. Hold for the long term. Look at that one. Yeah, you got any thoughts on BNG Foods while I pull it up,
Yeah,
Jeremy?
BGS Foods. Yeah, no, I've looked at them a few times in the past, and some other people that I follow on Facebook and Twitter and things. They're big fans, but it just never felt like the right purchase for me. So no, I don't have anything on that one.
No, yeah, here we go. So their
Hmm.
dividend yields 7.4%. They get a 40 unsafe score.
Yeah.
Let's see. I know they're like secondary brands. They try and flip brands is the best way I could put it. During the recession, they cut their dividend in 07, 09. And let's see. I just want to look at one thing. So they've pretty much the dividend's been frozen, so they're not growing it, which is always a red flag to me. They're down there. This is what I wanted to look out. Oh, so their
Hmm.
free cash flow payout ratio, according to Simply Safe Dividends, is 246%, 108% on the earnings payout ratio. Yeah, I'd probably stay away. And they are looks like they kind of started issuing shares, but they're still making sales. I would stay away from B&G Foods, quite honestly, in my opinion. Still holding my worthy bonds. Oh, very interesting question, Morton Matt. This one's going back. So we actually just um, sold all of our worthy bonds, and I debated on doing a video on this, which I'm sure I will. Maybe something really quick. Basically, they are still trying to get approval from the SEC for another issuance of bonds, 50 million at a time they can do, and it's made me nervous that it's going on about a year that they've been waiting, and the last ones were really quick. So it's a 5%. They pay that daily, and we just were thinking, you know what, we're gonna pull the money out because I'm a little bit uneasy about that. And, I'm sure it's fine, but you know what? And it's like Jeremy and I talk about if something kind of makes you feel a little uneasy and you don't sleep well at night. Not that it's keeping me up, but yeah. So it's just an app where you buy bonds and they pay you interest daily. So interesting concept that I've played around with for a bit. Uh, and says Costco needs to come down to 450. Uh, oh God, here we go. He also says, "What website do you use to do your research?" All of them.
Exactly. Yeah,
It's
unfortunately,
anything.
there's not one perfect website out there. There's quite a few that you have to use to get the bigger picture. Morningstar.com is a good one. Simply Safe Dividends is really good. I use Seeking Alpha a lot. Has a lot of good
Yep.
data there. The company's website itself is obviously the best way to start off. You get the real numbers
Yeah.
there. So yeah, you kind of have to piece together your research. I wish there was a better answer for all of us, but there really isn't.
Yeah, and I don't think there will ever be just like one website or two websites. You know, I on the channel for what I do, I'm really um, when I do more research, I think I'm going to just try and keep it to simply safe dividends and seeking alpha if I can. But honestly, we go all over the place wherever there's information. And again, the company's website, the annual report, just fantastic place to start. And then let's see, Morton Matt. That's not Morton High School, is it? I went to Morton High School in Berwyn, Illinois. That's for nobody. That's just me. I don't know if that name popped out. Since 400 subs, man, you've been in the early days. Yeah. So thank you. I appreciate that. Maybe we can wrap it up here with Trevon says, do you think IBM will turn around? This is an interesting one. What do you think, Jeremy?
Oh, IBM has been it's been a tough one to hold. I'll just leave it at that. Obviously, the yield has been great. It's a stable company. They're putting a lot of free cash flow out there, but will they be able to compete with the more current technology companies that are out there? I don't know. The Googles of the world, the Nvidias, and things like that. I'm just not sure. I think they'll always have a legacy business, and they're trying to go more on the side of the cloud, but it's going to take some time. I'm unsure where this one's heading.
Uh, yeah, I'm typing your website in there. Yeah, I sold in the bridge. I sold the shares. It looked to me, from what I saw, and I could be wrong, but it looked to me like they are borrowing borrowing money there to pay the dividend. And like I said, I could be wrong, but from what I looked at, that's what it looked like to me, and that made me a little nervous. And if I get a little nervous and see a red flag, I don't, I get out of it. I put my money into something else. All right, one more, and then we'll get out of here. What do we got from Phil, Mr. Philly? Do you guys have any non-dividend paying stocks? Do you avoid them at all costs, even if you would see a company like Google crash hard? Oh God, no. I have non-dividend stocks. Absolutely.
Yeah.
Okay, this is silly. I just added more Neo, and as I was talking to Darth Dividend on Twitter, and I said I don't gamble and I don't play the lottery. So for me, when I buy Neo and Alibaba, these are completely speculative, just lottery plays. And if they went to zero, it would suck, but I wouldn't be wiped out. It wouldn't kill me. So, yeah, I definitely buy companies like that. And then another one I did buy is Take Two Interactive. I had some shares of that in the Roth. So I like Take Two. They own Rockstar Games, and they're really trying to get into mobile gaming, which I think is pretty cool. So yeah, there's a lot of good companies that I'll buy if they don't pay a dividend.
Yeah, absolutely. Well, I haven't been buying many recently. I do a small purchase of Amazon every month. But other than that, most of my non-paying dividend stocks are ones I've had for many, many years, like Google and Netflix and things like that. But I would say over 99% of my new money goes to dividend stocks.
Yeah. All righty. Well, there it is. We're at an hour and 3 minutes. It goes by quick, doesn't it?
It does.
It goes by quick. So definitely make sure you check out Jeremy. Sign up for the email delivery on dividendstockpile.com. You know my channel. You're already here. And yeah, we'll have you on again. We'll do it again, man. This was fun. So, all right, everybody, we will talk to you.